A warm good evening to all the people, investors who have joined this evening's webinar. Artificial intelligence and machine learning have been buzzwords of investing worldwide, and it is catching up in India as it has been successfully implemented in the world of investing, which was heavily driven by human decisions till these tools are used for investing. A quant fund uses mathematical and statistical techniques on well-automated algorithm and advanced quantitative models to invest and execute trade, and 50% of US equity funds are quant-based funds, which is growing fast in India at a rapid pace is a testimony for success of these funds. Still, fund manager needs a very key role by monitoring the portfolio performance to the model's outcome. This needs a special skill and deep understanding of all related underlying asset classes, along with all the trading platforms. Here we have two learned keynote speakers. First, let me take the pleasure of introducing Mr. Nikhil Hooda, PhD in computer science from IIT Mumbai. He is also holding a BTech degree in computer science from IIT Mumbai, with the experience of working in algo trading platforms of Credit Suisse. Along with him, Mr. Atanuu Agarrwal, who is MTech from IIT. Both of them understand AI-based investing, which are suitable for any kinds of market cycles. I hand over the stage to both of them to make a presentation. After that, it will be followed by a Q&A. It's over to you, both of you, Nikhil and Atanuu.
Thank you, sir. Thank you for the introduction. So I've just put, shared my screen. I hope it's visible to everyone. As we promised with the title of this session, we must first address what's happening in the markets right now, right? So just as an experiment, we thought that, we'll show you, we picked a random point in the market. This is not what's happening right now, but we picked a random time in the market to see how the market reacts, right? And what all of our behaviors could be like when the market is behaving in this volatile manner, right? So the market starts off, relatively flat, assuming, right? And then it goes up a bit. Now at this point, it's up 30% for the year, right? Now at this point, would you buy or sell, right? It's very hard for any of us to make that decision. Maybe some people will say, oh, it's gone up 30%. Maybe I should wait for it to correct a bit before I buy again. But people who did that, who sat out of the market, it's gone up another 30%, right? So what do you do now, right? Do you buy? Do you hold? Now, when you decided to hold the last time around, the market went up 30%. So you lost money. So what do you do now? Do you sell, hold, buy, right? Now it's fallen 25%. Okay, now what, right? Lots of us will say, okay, there's a dip. So let's come back into the market a bit. Let's buy now, buy the dip, as a lot of us say, right? But now the market is down another 12% from that point, right? At this point, probably people start panicking, right? They say, okay, we thought that we are buying the dip. We thought the market will come back. Now it's gone down another 12%. But the market then moves sideways, right? So the point we are trying to make here is that as you can see from this market movement, which is not something that we've simulated. We've sort of taken a point in the history of Nifty and just overlaid it here, right? It is very difficult to exactly time the market, to exactly know when to buy, when to sell. It is impossible to do, right? And in my opinion, people who try to, like experts who try to guess which way the market will go in the short term, you might as well toss a coin, right? And decide based on that, right? It is extremely difficult to accurately predict, or with any certainty, in fact, predict which way the market is going to go, right? That is my viewpoint. And why is that? Because the market is an extremely complex system with many, many moving parts. So let's take today, right? So today, what all is happening in the market? So of course, there's Russia, right? Which is the big factor in the big elephant in the room, right? It's driving a lot of the commentary today. We don't know what's on Putin's mind. We don't know what's driving its decisions. We don't know when the war will end, right? Or if it will ever end, right? So complete unknown. No one knows. The US also doesn't know. So how can we know what Putin will do? Of course, because of that, oil prices are going through the roof, right? Again, here, there are so many factors at play just within the oil market. There are so many oil producing countries. How will Saudi Arabia react? How will the OPEC react? How will Venezuela react? How will the US react to all these changes? Again, very, very hard to predict. How can anyone accurately say, okay, Saudi Arabia is going to behave in this manner and US is going to behave in another manner? COVID, right? The biggest unknown. We all think we are past it, but cases in India are rising again. They're talking about a new kind of virus. They're talking about monkeypox. So again, how do you factor this into your models? Like how do you say, okay, COVID is gone accurately when even the world's best epidemiologists are not able to say it, right? Powell, right? Another factor, another layer on top of another layer, right? Again, how will you predict what the Federal Reserve is going to do, right? It raised by 75 bips now, but depending on how inflation goes, it might change its tack. There is no set rule that the Federal Reserve will raise interest rates up to 3.4% today, as all of us keep reading in articles, right? There is no rule like that. The Federal Reserve will react to how the economy is reacting to other factors, right? So it's another layer on top of another layer, right? And then all of these sort of mash together and drive the direction of the markets. And that is the reason why, I said what I said on the first page, where it is impossible to know the direction of the markets, right? Because there are so many layers. I just highlighted 4 things to you, right? 4 things which there is no way that one single person or even a panel of experts can accurately predict, because some of these are inside the brains of human beings, which is the ultimate black box, right? How do you know what a human being is going to do next, right? So this is a problem, right? Most of us who invest in the equity markets want what's on the top line, right? We want slow, stable returns, right? Which compound into returns over a period of time, right? So if someone came and told you that, okay, I will give you the 12% that Nifty makes in a year, I'll give you every month, I'll give you whatever, 1%. You would take it instantly, right? That is the best thing you can do. You will sleep very easy at night and you're getting return as if you put money into a fixed deposit, which is equal to the Nifty return. But that the markets don't play out that way, right? The equity markets play out what's there on the second line, right? If you, in any particular year, if you look at the returns of the Nifty, and if you look at it on a per trading day basis, out of 200 odd trading days, all of the return for the year is made in 20 trading days. What that means is that if you are out of the market on any one of those days, your return will be much, much, much lower than the Nifty, right? So you can't. So again, it is so hard to know which those 20 days are, right? And again, that is the reason why this is the exact problem that we at Upside were grappling with. A lot of investors had this issue, and that's why we've come up with Upside Navigator, right? Which if I was to put it in one line, the objective of the Upside Navigator is to deliver equity-like returns with debt-like stability, right? That is the objective of Navigator, and of course we'll come to it later on how we've gone about achieving that. I'll leave that for later. So this is a little bit about Upside. This is the founding team. I have had experience in the investment space for the last around 11 years. I was in New York for 6-7 years working in a multi-strategy fund, managing close to $1 billion across multiple strategies, including public markets, private markets in US and in India. I'll let Nikhil talk a little bit about himself, and then I'll cover Kanika.
Yeah, sure. Thanks, Atanuu. Yeah, so I'm the tech part of the team. As Sir graciously introduced us, both BTech and PhD from IIT Bombay, PhD particularly in optimization of really large distribution networks. And since then have been working on this. Was at Credit Suisse with Atanuu and Kanika. All 3 of us got to know each other then, and I'll let Atanuu introduce Kanika as well. Right.
So Kanika, like me, comes from the investment part. She's been on the buy side for almost all of her career. She's a CA ranker and a CFA after spending some time in the tax team at EY. She was at Credit Suisse in investment banking, which is where I met her. And then after Credit Suisse, she worked in a venture capital fund, Silicon Valley-based venture capital fund called Mayfield. She worked for the India piece of that fund, and she has extensive experience investing in startups across, all the sectors, hot sectors you hear about now. She was doing it many years ago, and now, of course, she started Upside along with us, right? So that's the founding team. And what is Upside AI about, right? Why did we start Upside AI? We believe that in the long term, technology and rules will translate to being a much better investor than any human being can be, right? Again, the reason for this is that human beings, by our fundamental genetic code, by our nature, are emotional beings, right? And often those emotions force us to do the opposite of what is the rational decision to make in the investment world, right? We often sell low and buy high, which is the exact opposite of what we should do, right? And because of that, machines have this unfair advantage where they are able to make these decisions completely rationally without any weight of past performance or any bias of any kind, right? And that is the logic by which we started Upside, because we felt that just like how it has happened in the West, where quant funds or rules-based investing dominates the investing landscape, it will happen in India as well. And over the next 10 years, you will see many, many quant funds come up, and Upside AI will hopefully be the leader in that pack, who's an early trendsetter in this move towards quant investing, right? And that was the whole logic for starting Upside AI. We are backed by some very marquee shareholders. India Partners, which is a venture capital fund which specializes only in deep tech startups, right? Startups that have developed their own intellectual property and are leveraging that to do business. That's the kind of companies India backs, and that's exactly what Upside AI is. All of Upside AI's products are based in completely proprietary technology that we have developed from scratch, right? We don't use any off-the-shelf products. So that's India Partners. And then Dr. Vijay Kedia needs no introduction. He was gracious enough to come in as a shareholder as well. I think his backing means a lot to us. It validates what we're trying to do. And of course, Ajay Nanavati, he's the chairman of Quantum Mutual Fund. Again, someone very well known in the finance space. He was the ex-MD of 3M in India. And then one more person who validates the technology side is Gopichand Katragadda, who used to be the ex-CTO of Tata Sons, right? And now, in fact, runs his own AI company, right? So we have a group of marquee shareholders, both from the finance side and from the tech side. And, that sort of just helps us along in our journey, validates our technology, validates what we're trying to do, right? So that's us. And again, I just want to make a very broad point, and then we'll dive deep into the product. As I was saying earlier, right, quant funds in general dominate the developed markets, right? If you look at the top 5 hedge funds in the world, they are quant funds. The most successful investor of all time is a quant fund, Renaissance Technologies Medallion Fund, which has delivered 60% plus annualized returns since the 1980s, right? Gross returns. So that is what's happened around the world. Even in China, 100 billion plus of AUM is now with quant hedge funds, right? So that's what's happened in the world, and we believe that will happen in India as well. And as I told you, Upside AI is hopes to be at the forefront of that trend and that movement. So what does the AI landscape quickly in India look like today, right? Mostly you'll find there are, of course, algo shops. There are lots of people, there are algo platforms as well, but most of them are on the left side of this graph, right? They are helping you trade better, and they're usually on the high frequency technicals arbitrage side, right? The fundamental side, right? Using fundamentals to invest, that is still the domain of human beings in India, right? If you look at mutual funds or other PMSs, they are run by human fund managers who are investing based on their own intuition, mainly, right? They all have Excel filters, certain criteria that they use to filter companies, but beyond that, it's all intuition, right? It depends on the manager whether he likes the management of the company or not, or he likes the business particularly or not. There is no one who's using technology and combining it with fundamental investing, right, at scale. And that is what Upside is doing. Upside differentiates, one, where the decision making is done purely by technology, and second, that we don't use any technicals, we use only fundamental parameters, both macro parameters and company fundamentals, right? So that's Upside AI. And I'll let Nikhil take over from here and talk a little bit about Navigator, which is what we are here for today.
Sure. Thanks, Atanuu. So yeah, as Atanuu started off, right, what we set out to do was create a product which gave Nifty-like returns, but with debt-like stability, right? And that's what we have here right at the beginning. We just want to show you the backtest that we have for the product, which is about 14 years of backtest before the sort of crash in 2008, starting before that. And as you can quickly see, the return profile, the returns are higher than Nifty, which is what we are targeting. But at the same time, if you look at the risk metrics, that is what is important, right? And the risk is significantly lower. The max drawdown, if you look at it, it's on a daily basis, it's 24%. On an annual basis, there is only one negative year out of the 14 years. And that is, again, of course, 2008, right? And in that annual year, whereas Nifty fell about 40-50%, Navigator fell only 10%. And even in the COVID period, for example, in 2020, where there was a 30% drawdown on the equity side, this product would have had only a 7 or 8% drawdown, right? And that's seen in the standard deviation and consequently in the Sharpe ratios as well, right? That with only a 8.7% standard deviation, it is it's like 1/3 the risk that you're taking on the equity side. And how it is doing this is basically we have a multi-asset product, which is investing across equity, gold, and debt, right? And we can see some of the allocations that it has done, the maximum and the minimum ranges throughout the period, right? So it goes anywhere from about 23 to 44. That's the minimum and maximum range that it plays in. And the idea is to be, again, not make very dramatic calls. We are not claiming to be God, where we will say, okay, now let's be 100% in equity, and then 3 months later, let's be 100% in debt. We are not making that dramatic a call, but make sure that there is some stability there, but at the same time, opportunistically move to what the asset class makes sense given the current macro conditions today, right? And that's one slide which Atanuu showed earlier, right? Pretty much where all these different macro factors at play, the Russian war, the inflation rates, the interest rates, how do all of those sort of factor in to the market conditions, right? And this is really what it's allowing us to do, right? It's allowing us to sleep peacefully at night. That's the goal. So what we here have is a quarter-on-quarter movement, right? What we saw on the left-hand side was the Nifty versus Nifty compounding over a period of time, right? So it was able to beat Nifty. But this is what it's doing on a quarter-to-quarter basis. And here what we see is this is where the stability is showcased, right? It does not have those extreme peaks and extreme falls. All of that gets clipped off, right? It plays in a much narrower range. So that is where the debt-like stability, you can sort of say, comes in, where you're able to say, okay, even now when those big shocks happen or these big falls happen, we are stable, right? We are not doing in one direction or in the other, right? And that is what allows us to give us the superior risk-adjusted returns. And this was the backtest that we showed you, right? The last 2 slides. Now, this product we have launched in December. And for better or for worse, it's been a great period to showcase exactly the strength of this product in the last 6-7 months or so. And we see in the live numbers as well, and this is including now all costs and including all fees, everything, that it's played out exactly how we planned it to, right? Where there have been so many shocks. First, it was the Ukraine war, and now with the inflation raging, there is all the interest rate hikes that all these central banks are doing across the world. And every time you see, right, that sharp fall happens in the Nifty market, the product is stable, right? It's remained stable throughout, which is like now giving you almost a 10%, frankly, with the yesterday's and today's fall as well. If you see tomorrow, there will be more than 10% alpha versus Nifty already. And that's almost like a 4 years, 5 years alpha in 6 months time, which is crazy to think of, but that's exactly what this product is trying to do, right? In these very volatile periods, give you that stability that you would want, right? And again, these are the same numbers shown more concretely. It's down 2.5% as of yesterday, whereas Nifty is down about 11.5%. And our holdings majority, the gold, as we said, is just going to be an ETF. On the debt side, again, we are not actively managing it. We are buying a off-the-shelf mutual fund, but we are holding only gilt. It's a gilt fund, so only government securities, taking no credit risk there, right? We are not trying to juice the returns by taking credit risk. And on the equity side, we have a proprietary system, again, AI-based, machine learning-based, which is holding about a 10 to 15 stock portfolio. And these are some of the sort of holdings currently that we have here. And right. So what is, again, we've shown you the returns and we've shown you the backtest and the live returns, but what is the actual process, right? What is the logic behind which this is working? So the framework really is, as I had mentioned, it's a macro-based framework where we look at the macro conditions that exist today, right, in the market. Be it the growth numbers, so that is reflected in the country's GDP, for example, right? How is that growing? And then what are the inflation rates? What are the interest rates? What's the volatility in the market? And not just looking at the Indian numbers, right? Because in today's world, it's a global world, right? What US numbers, what are the US inflation rates has probably more to say about the Indian markets doing than the Indian rates themselves, right? So how does what are all of those conditions looking like today? Looking at that and analyzing that, and analyzing the past, right? Looking at decades and decades of information in the past, looking at how the conditions existed previously, how did these different asset classes work, how did the asset classes behave in the historical period, and basis what we see today, pick that optimum asset mix, right? So that we can sort of make a educated choice in terms of what assets to be holding and in what amounts. And again, the target is 12 to 15%, basically a Nifty plus kind of a product in terms of return, but with much lower volatility and much lower drawdowns, right? And we've already seen that, as you see in the graphs, right? With the Ukraine attack and with these inflation rate numbers, it's been both in the backtest and in live numbers, it's playing out as we expected it to. And the three asset classes that we look at, again, equity, debt, and gold. The idea is minimum human intervention, right? Let the system build out the system. You've told it, okay, these are the macro numbers that matter. Now, how they matter, how much they matter, and what today maybe growth matters more, today maybe inflation matters less, whatever it be. Let the system on its own figure that out and make that determination. We will not sort of put that our lens on top of it. Let the system on its own figure that out and be dynamic, right? So that model keeps on adapting to the situation. It's not some static model that once we have backtested it, created it, testing it over some period, and then using that going forward. No, it's completely dynamic. It keeps evolving on its own, right? And the entire idea of being very stable, of minimizing risk, but not doing any FNOs, not using options, buying options to hedge or whatever. It's all based on long only assets, assets only buying, right? So that's what we are able to achieve, which is very a unique proposition we feel in today's market. We don't really feel there is anything quite out there, especially with this sort of quantitative approach to this product. Yeah. And here we have the sort of numbers comparing ourselves, again, backtest versus the other products that are there. These BAF kind of products are the most like to like that you would sort of compare ourselves to. And where we see our returns are, matching the best out there, but our risks are significantly lower. And if our risks are matching some other product, then our returns are much better, right? So on either of the two sort of metrics, we are outperforming. So overall, the sharp numbers look way better than, of course, the benchmark and versus our peers as well, right? And yeah, so maybe Atanuu can sort of quickly run through another sort of kind of innovative scheme that we overlaid on top of this product.
Yeah. So we are very pleased with the performance of the product so far, and we thought that how can we create another version of it to fit some specific use cases, right? And what I mean by that is there are often people who have accumulated a certain corpus and they are frustrated with deploying that corpus in fixed deposits. While they don't want to take pure equity risk, they also don't want the fixed deposit returns, right? Where you are actually in real terms losing money, right? When you are making 5% in a fixed deposit pre-tax and inflation is well above 7%, you're losing money in real terms, right? So we wanted to address that problem, address that group of people who want to deploy a significant part of their corpus in products that at least make them money in real terms, if nothing else, right? That was the use case for doing this, and we call it monthly income plan. Again, just to be clear, the product, the base of the product is the same. It is an upside navigator. This is just a variation on the structuring side, where we are enabling regular income. So I'll come to that. So again, how does the monthly income plan work? You give us a lump sum to begin with, and for this entire presentation, let's just use round numbers. So let's assume you give us 1 crore rupees to begin with, right? We will take that 1 crore and we will deploy it in Upside Navigator, right? That will be the underlying product. And with after deploying that in Upside Navigator, what we will do is we will start to give you a regular income from the 13th month onwards. So let's say if you give us money on 1st Jan 2022, we will start giving you a regular monthly income from 1st Jan 2023, right? So that's what we will do. The money will of course come directly to your bank account. This is now fairly standard. And again, the idea here is that we will give you 1% a month, right? So if you give us 1 crore, we'll give you 1 lakh rupees per month. So 12 lakh rupees a year. And I think that at 12%, any retiree or anyone who has this corpus will be pleased with the yield of the product, right? Because at 12%, you can you're making good money in real terms, and making 12 lakhs on 1 crore, I think even from a practical standpoint can pay for a lot of expenses, right? That's the logic behind the 12%, right? It's significantly better than almost 2x of fixed deposits, right? That's what this page goes into, right? As I told you the numbers, that you give us 1 crore, just to reiterate, that money grows for 1 year, and then from the 13th month onwards, we pay you 1 lakh rupees per month. And the way we structure this product, we made it a 100-month product, right? And you can renew the product at the end of the 100 months. So you will get 88 payouts of 1 lakh rupees each. And then at the end of the 100 months, you will get back whatever your capital has compounded into, you will get that money back, right? So this might sound familiar to you because we have essentially, this is a variation on the SWP that mutual funds do, right? Systematic withdrawal plan that mutual funds do. We have taken inspiration from that and created this structure, right? The advantage here is that because the Upside Navigator is such a stable product, unlike in SWPs where a lot of the times the units actually run out, right? If you're taking 12% a year out in a pure equity mutual fund or any other mutual fund, if the mutual fund return itself is below 12%, you have this rude awakening where at some point in the journey, the capital itself runs out, right? And you're left with no units. But because the Upside Navigator's return is above 12%, it compounds at above 12%, we found that in our backtest, we don't end up with that experience, right? So what we did is we actually benchmarked the Upside Navigator, the XIRR on this product against some of our competitors, right? The same mutual fund we showed you above. And as you can see, the XIRR is significantly higher than any other competitors, right? And that was the reason why this product works in this format. I think it's able to give you both the monthly income that you desire and also actually leave you with a significant amount of capital or most of your a good return on your capital at the end of the period, right? This is the underlying reason why. And again, just to illustrate this in very clearly how this would work is, again, the amount invested is on top, and then the monthly income you receive 1 lakh rupees for 88 months, right? That's the 88 lakh rupees. And then the lump sum at the end of the 100 months is something you'll get back. So we've just shown you a range of outcomes from a 9% assumed CAGR to a 12% CAGR. And we are showing you that even after receiving the 88 lakhs, you will actually receive a significant amount of money at the end of the life cycle of the product as well, right? So that's the example. And we actually did this analysis, right? We went back and we saw 75 rolling periods from 2007 to 15 onwards, right? To make sure that, okay, we are making this claim that this product will give you very stable returns. Let us test it on a rolling period basis. And that's what we saw, that the lowest amount received in that period was 1.8 crores, right? So that is the 88 lakhs and then whatever the principal is left, right? And the highest was 3 crores. So there was never a point where we were returning, where the capital that was being returned to you was below 1 crore or the units had run out during the life cycle of the investment, right? So there was never that rude awakening or that jarring moment that, okay, all of my capital is gone, right? So that's the beauty of the Navigator. That's the beauty of this product, that it can achieve that. I think that's it from me. Nikhil, do you want to add something to this, or we can then jump to questions?
Yeah, I think we are good to go.
Okay, great. So I'll just leave it here for a moment, and then we can take questions. And
While both of you were talking, Nikhil and Atanuu, some very interesting questions have been lined up for you. And two features I liked very well. Sleep well in the night, which is not happening for the last 8-9 months. The second unique feature is the MIP, and that gives continuous income, makes the product very unique. I'll get into the questions now. The first question is, I read out for both of you, and anyone can choose to answer. Since keeping up transparency is critical in safeguarding upside AIS model, do you believe that Indian investor will be convinced to invest in a non-transparent tech-based strategies?
Right. So I'll answer this question in two parts. Okay. So one thing is that how do we define transparency, right? Transparency in the sense that about the exact investment process, right? Which we are actually telling you the basics about, right? But what happens often is in people's mind, if a human being is explaining the process, they somehow feel it is more transparent than a technology fund is doing it, right? But in one sense, the human mind is also a black box, and in fact, our algorithm is not a black box; it's a gray box, right? So the transparency is, in my mind, equal to a human fund, right? And in second part, I want to make the point that, as I told you, most of the capital in the developed world is given to technology fund or quant funds, right? For example, if you invest in Renaissance or you invest in AQR or any of these funds, they will not even tell you what we are telling you, right? We are doing what we are doing because we are evangelizing quant investing in India. We understand that it's a new type of investing, so we need to be more give more information. People don't even get that information, and still that's the asset class that receives most of the money. So yes, I think definitely what's most important to investors is the fund managers and our approach, and whether we are fiduciaries, and the trust that we can build in the ecosystem. I think that is the main thing. And on the process side, I feel we are as transparent as any human fund manager. And over time, as quant investing becomes more and more common, people will become more and more common with not knowing all the details about the investment process, right? So that's my view. Nikhil, please add if I've missed anything.
No, absolutely. Like, again, when we are investing in human-based fund managers, how much are you really knowing, right, about the process? Of course, the fund manager will tell you that this is his thesis and story and so on. But really, when it comes to the nitty-gritty, investors are at dark equivalently, if not more.
The second question is, how often do you check the robustness of the model in a dynamic equity market, which changes every week?
Nikhil, you want to take this?
Yeah, sure. So we are constantly observing the model. Again, our plan is that the algorithm runs, it makes all the decisions, and we are there sort of as caretakers, making sure that it is running properly, right? And so because we are unbiased, because we follow the set calendar, right? Now, for us, really, and there are some other questions popping up as well about, what is the churn and so on, that it's really about, fixed calendar that we take, because most of these macro factors are coming out on a monthly or a quarterly basis. We look at it, the churn rebalancing or tuning of the portfolio, you can say, happens every quarter. So we are constantly, adjusting, and by we, again, I mean the algorithm is constantly adjusting, looking at whatever is happening in the market and tuning it as per the current environment.
Then we will get into the next one. Okay. And other than no emotion advantage in the quant-based funds, what are all the other advantages? You have listed a lot of advantages. Still, this question has come. And what is the other advantages over no emotion advantage, which is the biggest?
Right. So, that's a good question, actually, because see, no emotion you can achieve with a simple rule, right? I can say that I will invest the age-old 60-40 formula, right? And every year I will rebalance. I'll invest 60% in a Nifty ETF and 40% in a GSEC. And I will every year at the end of the year rebalance and invest 60. So that's also rule-based. There is no emotion, right? The advantage that a quant fund brings is the fact that we can be dynamic, right? That we can adapt to changing market conditions and also deal with more complex asset classes like small and mid caps or gold, which can be complex at times, right? So I think the biggest advantage is the fact that comes from the fact that there is a ton of data available today. Let's say if you compare the situation from 20 years ago, right, where data was hard to come by, today there is a lot of very clean, structured data available in the financial services space, right, which is available from multiple data sources. So what that data enables us to do is we can build machine learning algorithms on top of the data, where the algorithm can absorb millions and millions of data points and run millions and millions of iterations and come up with models which are very sophisticated and which are very dynamic, right? And which can deal with, one is complexity of different asset classes, but also the complexity of ever-changing market conditions. And what works in certain market conditions, what doesn't work. So that is the primary advantage of a quant fund was over the no emotion thing is of course very important, but the dynamic nature and also the ability to read complex data and deal with complex asset classes. I think that is in my mind, the two biggest advantages. Nikhil, please augment.
Yeah.
The next question is, the mitigation of risk is very important. How do you mitigate the risk in a falling market, both on debt and equity, as in your fund has outperformed Nifty by 9.1% since inception, which was commendable. He's congratulating you at the same time. How are you mitigating the risk, he is asking, through your proprietary module?
Yeah, so the risk mitigation really is coming from the fact that, first of all, it's diversified assets that we're getting into. Again, we know that gold is much maligned typically in investor circles. But because, when you look at gold on a standalone basis, then it doesn't really look that appealing, right? Its returns are middling. Its volatility is also very high. It's not like it is very less volatile. So although your previous generations loved gold, nowadays it's not really seen as a great asset class. But the point is that it works well in conjunction with the other assets. It is how these assets work together that makes sense, right? You can't just look at, if there are two very risky assets, theoretically some A and B, right? Both of them are very highly volatile, but together when they combine, they can give you a much better safety or whatever. And that is what is really happening here as well. Because on its own, equity is very volatile, gold is very volatile. Debt is, of course, the bedrock and is more stable. But combining all the three and then figuring out how to combine all the three in different scenarios is what is giving you that stability and is giving you that 9% or now I think over 10% outperformance. That it's really, that's the bedrock, frankly, of the stability is diversification. And that is a rule that even Graham, decades ago, he was saying the same thing, right? The number one rule of investment is really diversification. And we are not reinventing the wheel in terms of the actual assets, but we are just reinventing the wheel a bit in terms of how to look at those assets, right? With the sort of machine learning and so on.
Here I want to reiterate, in a developed market like US, 50% of the funds are in this kind of funds.
Right.
And they must have seen a distinct advantage over other funds, or otherwise they would have not put 50% of the funds in this quant funds. Is
absolutely
very clear. And the next question is, this is in relation to the monthly MIP. Okay, right. And this question is interesting. How often in your back test, the capital erosion happens? Will you continue to make monthly payouts even if there is erosion in the capital?
Right. So that's the slide actually I've shown with the rolling period return. If you want, I can show it again. Yeah. Let me do that.
So basically the point was that even in the worst case, right, when you entered on the worst possible day of the market, right, even in that scenario, and even when we had committed to that 1 lakh a month after the 12th month, even in that scenario, the lowest your sort of capital went to was something like 90 lakhs at the end of the period, right? So, and in conjunction with the 88 lakhs payout that you had, so 1.8 was your total payout in the bare minimum case. So that's why and Atanuu alluded to this also, right? That's why this product works, right? A pure equity or a much higher risk product will not work in this structure well because of the volatility. There'll be times when, you'll simply run out of units to pay out. But that we are very, very far from it, as you can see, right? Where the minimum point is also very far from zero. So it's never at risk of not being able to make the payouts or anything like that. It doesn't come close to that.
The next question, actually, you have answered. Still, for the benefit of the investor, I will ask, how do you select fund for debt? As you will have different entry and exit points, do you go down the line, the credit risk funds? Credit risk funds are funds which are will go below AAA and still those kind of funds are the credit risk fund for the benefit of other investors I'm talking. And do you go down the line in the bonds to enhance the debt returns? And you told you are into the gilts only. Still, can you answer this?
Yeah, sure. So basically, again, the number one rule for this product is safety first. Right. So when it comes to equity, we are only investing in large and mid caps. We are not touching the small caps. And again, there is money to be made there, but this is not the product for that, right? This is the stability product, which will, scale and give you the liquidity and be give you the peace of mind, right? So for all those reasons, on the equity side, it's only large and mid caps. On the debt side, it's only government bonds. We don't want to take any credit risk. Again, not to say that that's not a valid strategy, but for this, that ease of mind, that sleeping at night aspect of it, we will not take any credit risk on the debt portion. And gold is gold, of course. That is just through an ETF, the lowest cost possible that we can do.
I'll get into the next one. How are you able to beat the Quant mutual fund consistently? What is the secret sauce the customer wants to know? And the investor, potential investor. What separates Quant PMS from quant-based passively managed mutual funds? How different your PMS compared to Quant mutual funds is what he wants to.
So there aren't, if you look at the AUM in Quant mutual funds in India today, it's very low. I think it's like 2,000, 3,000 crores of, total AUM is 40 lakh crore or something like that. So it's a very minuscule percentage. There are a few guys, there are a few mutual funds who have quant funds in there. The thing with quant, just like with humans, that you don't exactly know what a human fund manager is thinking. I don't know exactly what every quant fund is doing within its under the hood, right? And quant funds have always guarded that very carefully. So I can't comment on their exact process. What I can tell you is that in terms of what we are confident about in our product is, I think our team is world class. I think it is extremely hard to find someone as talented as Nikhil for anyone, right? Whether it's any mutual fund Nikhil is the one who's built a product. He's, if you look at his PhD thesis, if you look at the work he's done throughout his career, it's extremely relevant. It's extremely sort of valuable, right? And that is, I think, one of our biggest strengths. And in terms of the passively managed quant funds versus active PMS, the difference really is in the process, right? There is no headline that I can tell you that, okay, this is the one definite difference, right? It's all process related. All I can tell you is that often in mutual funds, there are so many regulations that mutual funds get caught up, have many guardrails, and they can't do certain things which a PMS can do. Right? PMS has a lot more flexibility in terms of what the underlying products we are using or the models that we are building. In the case of mutual funds, they are very, very, both for regulatory reasons and also for their own, their whole internal hierarchies and corporate structure. They don't tend to be as innovative with the product as possibly a PMS will. Right? Today, once Navigator does well for a few years, maybe a mutual fund will replicate it and try to do something similar. But that's usually, mutual funds is not where innovation happens, right? Mutual funds try to do what is very tried and tested. And in most cases on the quant fund, what I can tell you is mutual funds are doing some sort of, static filters like PE, or, they're trying to do, I will buy if the stock market is under this XP, and I will sell if it is over YP, and that's how I will reallocate assets. So a lot of them I know are today using technical factors and making asset allocation decisions versus us where we're using macro factors. So we're going one level above, right? Mutual funds are using things that are reacting to the macro factors and making decisions. We are going one level above and saying we are using the actual signals, the actual macro factors and making decisions, right? And again, maybe after a few years after upside, Navigator has proven and has done really well. You'll see more mutual funds trying to do the same thing.
Apart from all this, on a 1 crore, no quant mutual fund gives 1 lakh every month, guaranteed, and that is another advantage. And the next question is, do you go and shop outside is what an investor wants to know. And do you go to US or Europe and when opportunity comes? This fund invests in some international stocks or funds.
Yeah, so in fact, not Navigator in particular. Navigator is created as an India-only product. But we are close to having a product which will be a US product. We will be launching it towards the end of this month, early July, and we'll come to you again, hopefully through PMS Bazaar and showcase that product. And I'll give you some flavor for it. The logic is that today, if you look at US products that are offered to Indian investors, mainly through mutual funds and maybe some one-odd manager here and there, they are very tech-heavy. Right. And in the sense, the reason I'm saying that is they're either an index fund, which is investing in S&P 500 or NASDAQ 100, or they are simply buying tech stocks. And S&P 500 and NASDAQ 100 is essentially very, very tech heavy, because the top companies by market cap are tech companies. They tend to be extremely high tech weightage indices. But the US is much more than that. Right. The US has the biggest consumer brands in the world. It has the largest healthcare sector in the world by an order of magnitude. Right, that's where all the innovation in biotech or genomics happen. Right, it has massive companies on the telecom side. So I mean, across sectors, there are like 11 sectors probably you can segregate the US into. There are really, really great quality companies that you can invest in. Right, so one is one part of our product will be that we will actually build a portfolio of 10 to 25 US mid and small cap companies, right, which are the actual innovators who are actually at the cutting edge of technology. We'll use our algorithms to invest and create a portfolio of 10 to 25 mid and small cap US companies. And the other thing, which is like the Navigator, where we will use US macros to determine which is the sectors to invest in. Right? For example, right now, when inflation is very high, when growth is sort of low, right? Tech is not the sector to be in. Right? And that's the reason why the tech has gotten hammered. Nasdaq is down 30%. But there is always a bull market somewhere in the world. No? That's the saying goes. On the other hand, energy has done really, really well. Right? Energy is probably at all-time highs. Right? So that was the sector to be in. That's the correct sector to be in. So we've built an algorithm that does exactly the same thing as Navigator, where it absorbs all this macro data and determines dynamically which sector of the US you should go in and come out of. Right? So that is another key element of that product. And finally, the product will also offer you the opportunity to get into sunrise industries, really cutting edge technology that is not available to Indians today, right? For example, if you want to play the EV space, right? Investing in Tesla may or may not be such a smart idea today, given where its valuations are and given the dependency on Mr. Musk, right? But the way you can play EV is investing in the lithium supply chain, right? And we can do that in the US. We can invest in companies that extract lithium, process lithium, right? And that we know is a really, really democratic way to play the EV space. Similarly, on the genomic side, right? We can invest in companies. We just heard about, that miracle cancer drug, which eliminated cancer in a small clinical trial, right? So we can invest in companies like that, right? Which are at the cutting edge of biotech. You've seen what's happened with COVID vaccines and, how successful the companies that have developed the COVID vaccines have been. Right. And so we will also have a portion of the fund reserved for investments like that, where we will invest in sunrise cutting edge technologies. So that will be the US fund. Sorry, I I got carried away and gave a very long explanation.
Yeah, but we're all very excited because that's the thing we are working on. And the idea is really to give you something other than FANG, right? Other than Facebook, Apple, Google, Tesla, like truly differentiated offering, just like with everything else that we do.
See, the next question is a very important question. Equity has got 10 and 15% taxation. debt, if you hold for 3 years, indexation comes, and gold has got a different taxation. What are all the tax implication on the fund at the end of period on year basis?
Right. So this is the number one question that we actually get after the presentation, frankly, even when we are one-on-one doing it with clients and so on. And the real answer is that that's the number one worry, right? Okay, equity is fine. 1 year is, after 1 year long term kicks in, but it's 3 years for gold and debt. So if you're putting my money into gold and debt, I'll be paying a lot of high taxes because you're saying you're rebalancing every 3 months. Every quarter, the model is sort of adapting, right? So the answer is key actually. We had shown you at one slide, the allocation ranges. So although we are rebalancing every 3 months, it is not very dramatic. It is not going to be, suddenly you've sold all your gold and suddenly you have to pay a lot of tax. That's not what's happening. That's not the idea, right? So it's like little adjustments, little fine tuning that is done quarter on quarter. So what ends up happening is that after the 3-year period, most of the transactions, in fact, almost all of the transactions are all in long-term units. Because of the FIFO thing, it's all going out of your long term. So if you're holding for a long period of time, like in the product that we have with the monthly income plan, or even just normal holding it, right? Just investment and holding it for a long period of time, post the 3-year period, most of it, in fact, almost all of it will be long-term taxes. And we've done, again, detailed NAV series testing, and any sort of channel partners or clients we can share those details separately. The headline number is 17 to 18%. That's what the tax rate comes out to. It's not as high as 30-40%, which will be the short-term tax rate for gold and debt. That's not the case. It all comes down to about 17-18% on a year-to-year basis.
And I'll just add a couple of things. If you compare that to what's in the market today, right? So on the one end, there are some fund managers who offer absolute return products, right? But the issue is that most of them are in the AIF format, and even if they are in the PMS format, they're using derivatives.
Correct.
Right? They're using some FNO in their fund, which means that is going to be taxed at marginal rate no matter what. Right? And for most clients here who are in the highest income tax bracket, that will mean 40% tax rate, and in the AIF, so automatically it is 40%. Right? And then on the other side, there are mutual funds where if it is truly a balanced fund, if it is truly a fund which is not sitting 70% in equity like some BAFs are, then you are paying 20% with indexation, right? So I think from a taxation point of view, upside stacks up very well on either side of the spectrum, whether you compare it to AIFs and PMSs offering absolute return products, or mutual funds, which are not, where there's 20% in indexation.
See, Arshit Patel is asking this. How often is the rebalancing of asset is done? You have answered partially, and can you elaborate, please?
Yeah, so on the equity side, just the equity portion is sort of more or less looked at on an annual basis, again, from a long-term taxation point of view. After the 1 year, it is sort of rebalanced so that the investor gets the advantage of long-term taxation on the equity side. And the overall allocations across equity, gold, and debt, that is done on a quarterly basis. So every quarter that is sort of tuned, as I keep sort of saying. And again, the reason really is because most of these macro factors that we are looking at, they sort of change on a monthly or a quarterly basis. So that's the natural unit of time.
Manish Singh is asking, how do you fundamentally evaluate gold, is what he wants to know.
So yeah, I think again we sort of talked about that. Like typically people look at it very negatively, but in conjunction with equity and debt, we like gold as a hedging asset. And again, if you look at it in dollar terms, it's not giving you great returns over the last 20-30 years. But in Indian rupee terms, it has given you those decent returns, and that it's effectively an alternative way to play currency. It's effectively, letting you play the depreciation that will naturally occur in the Indian rupee versus dollar without actually looking at any convoluted currency products or whatever, right? So I think in multiple ways, it offers a good hedge.
I'll get into the next question. This is from Lokesh Nagpal. Can you explain what would lead to the exit of a stock what leads to an entry as per your AI engine is what he wants to do.
So again, because of limited time, we've not really gone into the equity portion so much. But very quickly, I'll give you a rundown that, as Atanuu said, right, even on the equity portion, it's not technicals based, it's nothing, it's all fundamentals based. When we are making a decision on a company, what we are really looking at is balance sheet, is P&L, it's cash flow, all of that, not just currently, but over the last 6 years, we are seeing how that is evolving, how the market situation is evolving, and what is the price at which that security is available at. So all three factors matter. So I cannot give you one answer, right? The stock might go down in price, but we might still continue to hold it. We might buy even more of it, right? Because the fundamentals might be working for it and the market might be turning. So we are bullish in the future. Or it might have gone up a lot and we feel, okay, now it's there is still room to grow because the fundamentals have grown. So basically, it's all three factors that together matter. So it's not one size fits all. Again, we have told the algorithm, okay, look at these fundamental numbers, right? Look at the P&L, the balance sheet, and so on. These things matter. This is what eventually determines long-term price. But we have not told it what matters, how much, in what scenario. We are letting the algorithm determine that on its own. So that's a constantly evolving model which changes every time as the market conditions change. Because that is true, right? Market is not static. Market is not ek baar ho gaya, ek baar train kar diya, and that's it. You can just run the same model again and again. Markets, we have to keep up with the market.
See, he has not put his name and he has put initials. GG wants to know, does the backtest is realistic during 2019 to 2021? It is a specific question.
Right. Again, our idea was to have the longest backtest for any of our products that we develop, right? For the Indian markets, what it meant was, because we need 6-7 years of financial data, as I mentioned, for the equity portion, and data was really clean, data was really available from post 2000. The earliest we could start was 2007, and the latest we started was as recently as possible. So again, any of our products, it was a long duration. It takes a fairly long time. So since we launched finally in December 21, we have backtested all the way till 21, right? So it includes those years as well. It includes the COVID crisis, and I think it stacks up well. And again, as we keep repeating, we have got the fortunate scenario of in 2022 also, that scenario is playing out, right? That volatile scenario is playing out. So the backtest seem to be getting vindicated, at least till now.
Next question is from Indranil Sarkar. Does the returns, the illustrations of upside AA include buy, sell, commission charges and taxes, long and short, for every portfolio rebalance?
So we include all charges. The return numbers include all charges, including our management fees, everything. The only thing it does not include is the taxes, right? So it is gross of taxes, because again, taxes depend upon a lot of factors, including some that are not in our control, as to when the investor redeems the funds and all of those things. So that is why we can't include taxes, but everything else, yes, all other brokerage charges, management fee, transaction charges, it's net of everything.
And as you said, if you're holding it for a longer period of time, expect 17 to 18% as your effective tax rate on this product.
Yeah. The next question is, how relevant it is in an uncertain market we are going through, which is likely to continue for next 1 year as per experts. How relevant is the product upside AI and in the market prevailing now?
Yeah, I mean, first of all, I want to caveat experts. It's very hard to say when the volatility will continue. I think it's impossible to predict. But I think upside AI in general, and specifically the Navigator, is extremely relevant because of the fact that because it's an algorithm and because it is not some human manager who is a growth investor or a value investor who can only do well in certain kinds of markets. In our case, the algorithm can dynamically adapt to the markets. It can change with the markets and pick the right asset allocation or the right portfolio that is conducive to that particular market. And that is even more relevant when the market is volatile, because the market conditions, what the market likes, what the market doesn't like, is changing constantly. So in that scenario, a human fund manager who only invests in one way will probably have a hard time dealing with the volatility, right? But in our case, because we have this inherent advantage, I would say that upside's relevance is even more in a volatile market. And of course, there's, as always, emotions, right? Even if your processes are fine, if you let emotions into decision making, they play out in the worst manner in volatile markets, right? And we, again, because Upside AI's core mission and core philosophy is the fact that we don't let human decision making or human emotions interfere with investing decisions. We are protected from that perspective as well, right? Where a algo which is completely ruthless, does not have any bias, can make optimum decisions at every point in time without any of us holding it back.
I wanted to thank Nikhil and Atanuu a lot, and with a lot of clarity you have answered each and every question with patience and to the point you have talked, and thank you very much. I want to thank the participants who have joined this webinar also. I want to thank everyone, all the investors and Nikhil and Atanuu. On behalf of PMS Bazaar, I wish Nikhil and Atanuu, other promoter also, all the best in all your future endeavors. All the best. Thank you very much.
Thank you, sir.
Thank you, sir. Thank you so much. Thank you.